Hello and welcome to episode 434 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leeks. Damien, welcome back. How are you doing?
Well, I would love to say great, but anybody who watches the video version of this podcast, the bit we're doing later on, you'll notice that I've got my hand bandaged. So this week I spent Monday in hospital. It was planned, so it's one of the benefits of health insurance, something we've talked about in the past. I had a problem with my carpal tunnel on my right arm. Basically, I think I, over time, probably strained, but also I had a cyst in my wrist internally, it came to light, that was causing pressure on my nerve, that was causing me loads of pain, so I couldn't use my right hand properly. And so I had an operation on it to remove it, but there was me thinking it was an in and out job and I'd be back to normal the next day. Well, I was in and out, but I was actually put under general anaesthetic. But now I can't drive for a couple of weeks, and it's actually a bit more of an operation than I originally thought. So I'm not saying that for sympathy, but I'm saying almost for sort of comedic value that I'm walking around now and can't do certain things. But it does mean that I can use it as an excuse at home not to do things like, I don't know, empty the dishwasher.
And letting people behind the curtain, you would think that perhaps Damien has eased up a little in terms of work, and he has, to be fair, but he's found other ways. He's embraced technology to still get in touch with us and check things.
Well, I have, and I'll share this with people because there are people out there who may have, I know, similar problems, but also as an alternative in terms of productivity, I've started using voice typing. So if you use a Chrome browser, you can use that to control nearly all of your PC. So you can use it to dictate. Now, I've used it in the past, but it's definitely got a lot better. So I've been using that to write articles. If you're an 80/20 investor member, you would have got an article about my portfolio this week. That was written entirely using voice typing. Journalists have been in touch. So if you'll see something in the national papers this weekend, possibly, maybe next, that was all done via voice typing. So it is quite incredible what you can do. But from a productivity point of view, the reason I mention it is sometimes a change is as good as a rest. So doing something differently can be quite motivating and quite energizing. So I found it's actually quicker to dictate than it is to type, and I'm quite quick at typing, so maybe try it. If you might find you actually quite like it. The only thing I would say is you have to be in a very quiet room, because then when the kids came in from school and I was working at home and they're shouting upstairs and stuff like that, I did then start having 8-year-olds sort of babblings and shouts in my work. So you have to be somewhere very quiet, but it was something that I did quite enjoy using.
I've dabbled in dictation mainly on my phone when I'm driving, things like that, when you're typing out messages and you use the various things in your phone to do it. The only thing I find with that is it sort of almost pressurizes you to quickly finish what you're saying because it's ready to send, and to the apps and everything, you've got the ability to kind of, it just listens in the background. There's no sort of pressure to finish what you're saying.
No, I tell you what it does do, you can actually tell it to go to sleep, and so you can pause it without actually having to touch it. So it is quite good. So you can then have a flow of saying things and then tell it to go to sleep, and then you can tell it to wake up, and it will actually, it's always listening, but then it only activates when you tell it to. And I actually was quite impressed. I used it years ago, wasn't so impressed, but now I am. So something for people to consider.
Okay, so with all that time that you've had in your resting and recuperation, this is going to be an absolute barnstormer this week, I'm sure. So what have we got coming up on this week's show?
No pressure there, Andy. In theory, I actually have less days in a week to do it, but yes, nonetheless, it is going to be a barnstormer. The first piece I'm going to be doing is about Money Dashboard, as we promised. So Money Dashboard is an app that has been called a budgeting app. Mentioned it last week. I've gone through, looked at all the apps, tried alternatives. I'm giving my verdict with the help of Lauren on the one I think is the best alternative. I'm also going to be talking about mortgages. So there's been an innovation in the mortgage space. Very low interest rates of people who may be worried or struggling when it comes to remortgaging. You can get rates just over 3% now, but there is a big caveat. So you're going to see lots of news about these new products from a particular building society, but I want to talk about them. But it does highlight something that you do need to be aware of when you are looking at mortgages. And the final piece, I'm going to do something that is inspired by a question from one of our Instagram followers, actually, in relation to savings for children and taxation.
Okay, so let's get on with the first piece of the podcast then. Lauren's in the studio, ready and waiting to go. Damien, budgeting apps, alternatives to Money Dashboard.
So as promised, we are going to be looking at the alternatives to Money Dashboard. Now, if you listen to this on the podcast, it is being made as a YouTube video. So I apologise to anybody who's got to stare at my bandaged hand after the operation that I mentioned earlier in the show. But Money Dashboard is an app that I used extensively. It's a budgeting app, and there was a news that's going to close at the end of the month. So the end of October, the app will be no more. We're going to put links in the show notes of this video and this podcast to a news article that gives all the details about what is happening and why, and also tells you how you can export your data or actually have it deleted from Money Dashboard. Now, of course, when the news came out, we had loads of emails from people saying, what should I do? What's the best alternative out there? Because if you're like me, I actually became quite reliant on Money Dashboard. So Money Dashboard was probably wasn't quite my most used app, but I did go into it multiple times a day. And it's one of those things, once you set it up, your finances would run smoothly and you'd be able to just monitor things. And of course, when the news broke, anybody in Money to the Masses Towers could tell you I was a little bit downhearted and distraught, having to try and find an alternative. And so because of that, I then spent the next few days after the news came out trying to find alternatives. And the main alternatives out there are Emma, Snoop, and Money Hub. Now, what we're going to do is Lauren's come onto the show because Lauren knows all of these apps inside and out, reviews them for Money to the Masses. You can find reviews about any of these investing or money management apps. So things like Emma, Snoop, Money Hub, Plum. You can find them all on the Money to the Masses website. We'll put links to them in the notes of the video and podcast. And so Lauren's going to run through some of the highlights of what these apps do. I will say that we are not including Plum because Plum really has moved it more into the sort of saving and investment space. So it's not an alternative. Now, all of these apps, I have to say as a caveat, are good apps in their own right. So there'll be people who might watch this and listen to it be thinking, oh, that's my favorite. I can't believe you've dismissed that one and picked the other one as your choice as the Money Dashboard alternative. But I'm looking at it through the lens of somebody who was a heavy Money Dashboard user, liked what that did, which is different to some of the other apps, and then found the best alternative in my view. So Lauren's going to kick this part off, giving an overview of what the apps do, and I'm going to tell you which I picked and why I'm now using a different app and which one it is.
Yeah, so first we'll take a look at Emma. I would say that the Emma app used to be one of Money Dashboard's biggest competitors because it had a lot of the free budgeting features that Money Dashboard had for quite a long period of time. But now a lot of those features have become quite restricted on the free account, and you do have to sign up to a subscription plan in able to benefit from those kind of features, which is a bit of a shame really because the subscription amount are quite expensive and they range from $4.99 to $14.99 a month. Now, Emma does often have deals and offers in the app where you can get up to 30% off, or you can buy an annual one and save a lot of money on the monthly cost. But I am slightly hesitant with the fact that you do have to pay so much money to be able to get a hold of your budgeting. It kind of seems a bit backwards to me, even though they do offer great features. To be paying £15 a month for the privilege to do so doesn't quite sit right with me, really.
So one of the things that we laughed about in the office is I likened it to Pizza Express. So has anybody ever paid full price at Pizza Express? There's always a discount, and Emma does work a lot like that. So a lot of the people I know that use it, people who are in the office who have used it in the past, there are often discounts. And when we were making this particular episode, Emma, probably in response to Money Dashboard, were giving some really hefty discounts on the prices. I mean, sometimes I've seen things as much as 70% off. So I would say the price points, which can go up to like $14.99 a month, so somewhere between £5 and basically £15 a month, you can get them heavily discounted. So do look out for that. But I mean, you mentioned about the different plans, but what do the different plans give you? You get the free version, but as you go up the plans, what's the real difference?
Yeah, so the free version at the moment, you can only actually connect 2 of your bank accounts to compare. So before, you could connect as many as you wanted. There were slightly limited features with offline accounts and investment accounts, but now they've really limited and restricted it to only 2. So if you're someone who has multiple bank accounts, then you would need to sign up to a subscription plan to be be able to connect more than two. One of the key features that it does actually offer, though, is rent reporting. So what it does is if you do pay rent, you can have your rent payments reported to the credit reference agencies. Now, the $4.99 a month plan only reports it to one of the credit reference agencies, but if you pay for the slightly more expensive plans, then it will report it to all three. So that is something to consider if you are thinking about buying a house in the future, then that could help you with your credit report. And another of the key features that you can get with Emma is savings goals. So if you want to set savings goals and kind of work out your budgeting and your saving in your accounts to save towards a particular goal, then this is something that does come along with the subscription account. But again, this is a premium feature, which was something that was previously offered for free with Money Dashboard. And with your app only banks, if you bank with Monzo or Starling, for example, you can do that for free with them. So that is something to consider. And I don't necessarily think that that is something that is worth paying for a subscription plan, in my opinion.
Yeah, and one of the things, like Emma, I have to say that I do really like is that if you have regular payments coming out of your account, so direct debits, for example, it does highlight when they go up. And so if you have a direct debit and they creep up just a little bit each year, it will tell you that it's more than you paid previously. So you'll start to notice. And there will be people out there who will be using the app who suddenly noticed, hold on a second, my Netflix or whatever may have gone up. And then they go and look, and then they realise that they probably did have an email telling them exactly that, and then they can make a judgment. So I do like that about Emma. Moving on to Snoop.
Yeah, so Snoop, when it first came onto the market, it largely focused on trying to save you money in your bills. So initially, I think quite a lot of people were quite apprehensive with the name Snoop. It sounds like someone's snooping through your finances, and do you really want to connect your accounts to that? But actually, what it was trying to do is have a look at your bills and see where it could save money. And that was where it was largely focused within the app. But it has had a few updates since then, and now it really has enhanced its budgeting features. And I think the budgeting features that it offers are very similar to what Money Dashboard did offer for free. But Snoop does have two accounts. So it has the free plan, and then it has Snoop Plus, which is $4.99. And I know that when you looked in it, you did actually find that in order to pay the $4.99, you needed to get access to the unlimited custom categories and the tracking your spending from payday to payday. So it depends whether you think something like that is worth $4.99 a month, because that is something that obviously was free with Money Dashboard. So it depends how you manage your finances, really, and whether you can do that, because obviously unlimited custom categories, if you're that detailed in how you sort out your budgeting, then I can understand that's quite an important feature, but you are paying $4.99 a month for the privilege.
Yeah, and I'll point out that Snoop was the one that Money Dashboard almost recommended in their closing email they sent to people. They put a link in there that pushed people across. Now, I'm not going to go into why they picked them. I did think it was slightly odd that they picked Snoop, but well, it has a free version that does give you quite a bit. So moving on now to the last one, Money Hub.
Yeah, so Money Hub, I would say, is probably the closest to Money Dashboard. If you are someone who's really devastated, like you are, Damien, that Money Dashboard is closed, then I think it's worth taking a look at Money Hub. I think you should download all of them and have a bit of a trial just to see how it works, to see which works best for you in your circumstances and how you like to manage your money. But Money Hub, I think, offers the best kind of features closer to what you would have done with your Money Dashboard account. There is a monthly subscription fee. It's £1.49 a month or $14.99 a year. However, you do get 6 months free. So, I mean, I don't know any other app that gives you 6 months to kind of get the hang of it before you decide if you want to commit. And what I really like about them as well is that they don't automatically renew the subscription plan. So if after the 6 months you forget to cancel, it doesn't matter. You're not going to suddenly start paying for something that you're not using. And I quite like that about them. So they obviously have quite a lot of faith in their products that if you like it, they know that you're going to sign up. One of the other key things with Money Hub is it offers additional features such as forecast, which I quite like. If you have kind of got a hang of your monthly budgeting, but you want to start planning ahead, I don't know, for saving for a house, a wedding, retirement, then you can use the forecast feature within the app to kind of think ahead and start putting money away for something else as well, which I quite like, which some of the other budgeting apps either offer in their subscription plan or don't really think about offering at all because they're kind of focused on the here and now. So that is something. The one thing that I would say with Money Hub though is I do think the 6 6-month trial is beneficial, because I do think it will take you a little bit of time to kind of get your head around how it works. I've found when I've used it myself and logged in, it seems quite daunting and quite complex at first. It seems like a spreadsheet in an app. It's very basic. The other ones are kind of gamified, aren't they? They've got bright colours and it seems quite easy to find out how you set things up, whereas I find MoneyHub is a bit more dulled down, which I quite like in some instances, but I do think it might take you a bit of time to kind of get it exactly how you want it to be before it's all bells and whistles and everything's running smoothly for you.
So now I'm going to tell you which one I went for. So like I said, I was devastated at the news and I went through all of them. And so I started off, and I've used Emma in the past and played around with it, because obviously I like to use all these products because we review them. I need to know how they work. And obviously Money Dashboard pretty much gave you lots of the features of budgeting that the others would charge you for. And there are obviously some things that the others will do that Money Dashboard didn't. But I love the fact that I could do customized categories, change the pay date, so I didn't have to go from the first of the month to the first of the month. I could do all these things on Money Dashboard without being charged. And once I set it up, and it takes time to set it up on Money Dashboard, then you can just open it up and check it. And of course, depending on how you use Money Dashboard, it will ultimately dictate which of these you like. So I looked at Emma. Now, one thing I would say about Emma is if you want something that's free, because obviously Money Dashboard was free, you go across to that app. It does feel like when you download a game and you start playing it and you don't want to pay for the game and you get bombarded with adverts. And so that is incredibly frustrating, because there is just a drive to make you pay. Now, I understand why. Ultimately, Money Dashboard didn't find a means of being able to sustain themselves. Oddly, if I'd been able to pay a few quid perhaps a month for Money Dashboard, I probably would have done, given how much I used it, but that was never an option. They've obviously now closed the app. So with Emma, when you use the app, you do get bombarded with reasons to upgrade to one of their subscription plans. So one of the things that had changed since I previously looked at it was the inability to just update the app whenever you wanted. So you go in there, and on the free version, you can only update the numbers in your accounts once a day. Now, I find that's frustrating, because I'm the sort of person who likes to be quite granular, and if I'm doing spending, and don't forget, if you've got household finances and your partner's out doing things and spending money, then that is something that you might want to get visibility on when you're doing your budgeting, so you can both go and look at it. That is a slight restraint on that. One thing I do like is that it does show you upcoming payments, including transactions that have been made, so pending ones on credit cards. A drawback on Money Dashboard was that you could use your credit card, you'd have transactions that wouldn't clear for a few days. They'd show on your credit card if you went into the app, but on Money Dashboard they didn't show, and therefore they didn't impact your budgets, and so it was always slightly out if you were a big spender in terms of number of transactions you did. So that is one positive for Emma. The cost is, in my view, quite high if you are going to pay the full price, but like I said during the earlier part of this piece of the pod, there are often offers. I think it's a very good app. I have to say, it is one that I think a lot of people will find easy to use. It's quite slick to look at. It's got good budgeting stuff, good prompts. It highlights how much you've got in remaining budgets. Its way of categorizing transactions is brilliant. It does that very well. So it's almost that you could just allow it to do a lot of the stuff. It's very, I think, easy for somebody who's not into budgeting. I think Emma is a very good app, but for somebody who was really into it and using Money Dashboard, I think you'd go to Emma and find it frustrating that you can't use it for free. You can't even update things as regularly as you'd like. I didn't use the online element of Money Dashboard, so the website, web portal. Emma doesn't have one of those, so it is just all app. I just use apps anyway, so I like that. So for me, I very quickly got frustrated with Emma because I couldn't do the customization that I wanted. It's almost as soon as you want to do something, you've got to pay. And the cost I thought was prohibitive. So even though I could have got it very quickly, and I did, to doing what I wanted on Money Dashboard, to do it continually and as much as I wanted with such regularity, I was going to have to pay. And that was when I then moved on and had a look at Snoop. So Snoop is free, has a free plan. And that was one of the things the email from Money Dashboard was really heavy on promoting. I started to use Snoop. I was amazed how the app had evolved. It was quite slick. I like the design of it, and I started to use it, put my accounts in there, and then very quickly I hit a bit of a snag. So the way it displayed things I found quite cumbersome. For example, when you list the transactions, rather than listing it by your budget, it would list it by the card, for example, that it come from, like a credit card or your joint account or whatever account you have. That meant that you had to keep going into each transaction to try and get a bit of visibility. When I have a budgeting app, and the reason I like Money Dashboard was when you set it up, you could have a very high level view of things, and things would drop in and you just looked at it. Have I ever spent on my discretionary budget or my bills? No, great. And so you didn't have to do too much. It was just almost a plate was being spun. And I found when I was looking at Snoop and trying to set it up, I didn't get that transparency when I opened the app. I found it a little bit cumbersome. There may be people out there who might say, yes, you can work it around another way and you can get it on a different view. I'm just saying from my initial look at it when I was using it for a while, I found that difficult. I didn't like the fact I couldn't change the cycle, so I couldn't change it from the first of the month to the first of the month. As soon as I wanted to do that, it wanted me to pay and upgrade, because I was getting a lot out of the free version of it. But as soon as I wanted to change that, so if your payday is not on the first of the month, or you don't budget from the first of the month to the first of the month, straight away you've got to pay. And so at that point, I then started to hit the snags. And so I then did go onto MoneyHub. I thought Snoop was going to be the answer. And then I thought, no, it's not. Went onto MoneyHub. Now, MoneyHub, I have to say, it took me time to set it up. And it isn't like Money Dashboard, but is at the same time, if you get what I mean. There's elements of it that look and work in a very similar way. It's much more granular, but also it gets a little bit too granular. So if you think there's a line of sort of simplicity to complexity from left to right, I think Emma is down the left-hand side, very user-friendly, but it costs. If you move up and you get things like Snoop, but then you eventually get to Money Dashboard, which was free, but higher complexity, but then you get MoneyHub that's a little bit more complex. And what I found I was having to do was slightly dumb it down. So I started using it, and it took me pretty much a half a day, I'd say, to set up the MoneyHub system to mirror Money Dashboard. And one of the issues I had was that MoneyHub likes to be very granular. So it will give you what's your budget for your mobile phone, a budget for your broadband. I don't think in those terms. I have a very broad bills budget. So if you budget in certain ways, like I, for example, look at bills as a totality, I would look at discretionary spending, food spending, travel would be another one. Those sorts of budgets that I would look at. And in Money Dashboard, be able to just have things assigned to those broad categories. Even though there were subcategories, what you could do in the overall budget, we could say all of these categories that could be, for example, spending on eating out, or could be on general shopping, could be included in a overarching category budget of discretionary spending. I've not yet found a way to do that in MoneyHub directly as it's set up. You seem to have to do budgets on each thing. The workaround I found was having to create a custom budget, which I then assigned all these things into. So I don't now see how much I spend on eating out. I just have to put it all in discretionary. Whereas previously you could put it as eating out, and that could then fall into your discretionary overarching budget. I haven't yet found a way to do that on MoneyHub. If you know a way of doing it, and put it in the notes. What I'm doing at the moment is creating the overarching discretionary spending budget and assigning everything that I want to go into that. So I've pretty much managed to mirror how Money Dashboard worked for me, but it's slightly different, and I'm having to just be mindful of the way I categorize things. After that half a day of setting up, I'm now happy. So much so that I've actually stopped using Money Dashboard, even though it's still open for the next week or so. I've stopped and moved directly to MoneyHub. Now, the one thing I would say about MoneyHub, it prompts you, transactions occur. Are you happy with the category it's in? Money Dashboard was very slick at putting things in categories. It learned from what you were doing previously, what you'd put transactions into. It would just then realize what the rule was, and it would move things in there in the future, auto-categorize. I've yet to see how good MoneyHub is at doing that. I don't mind the prompting, because I therefore make sure things go into the correct category, but I do like MoneyHub. And the fact that it's only £1.49 a month after the 6 month trial, I think that's fair enough, because ultimately, if there isn't a way of making money, then these things could end up going the way Money Dashboard did. And as I mentioned earlier in this piece, if Money Dashboard had allowed you to pay a couple of pounds a month, I probably would have done it for the ease and convenience of it. Now, it doesn't have some of the features of things like Emma in terms of being able to show me the increase in certain direct debits because of the way I've set up my budgets within the app. But as you say, you could become an absolute power user of this and start using all of the different tools, forecasting, really go granular, and then you would get loads out of MoneyHub. So I've simplified it its usage, but I could go and become an absolute power user and putting everything in there. So I don't think I'll get to that, because for me, it does what I need it to. But I think overall, MoneyHub is the one that I'm going to go with. So the others aren't bad apps, but I think if you are a Money Dashboard user, you use it in a certain way, you like the features, I think you'll get on much better with MoneyHub. And a few people I've had discussions with via email afterwards have shared some of those views. So I've been quite heavy there as a user, gone quite granular on how these apps work. If you're new to budgeting, one thing I would say, we'll put a link to a budgeting spreadsheet we created at Money to the Masses, which makes it really simple, that allows you to create budgets, but then also takes you on that journey of maybe exploring some of the apps to help you with the daily management side of things. So if you're new to budgeting, then hopefully that's giving you a bit of a steer about the types of apps. But then, Lauren, there are other things people can do. They don't have to use these apps.
Yeah, if you don't want to use your apps and connect your other bank accounts for it to be in one place, because the apps really, they're a bit like a spreadsheet on your phone, aren't they? I mean, I've used all of them and connecting the accounts, but in all honesty, sometimes when you have to keep refreshing it every 90 days, I do forget. So what I tend to do is I use Starling, Starling, Monzo. I've banked with both of those, and Starling has the really great feature of the spaces. So I use my budgets where I've got bills, I've got food, I've got a petrol one, and now you can create the virtual cards from them. So when you go and do your food shop in Tesco, Sainsbury's, wherever, and you go to your till, you can have that on your Apple Pay. So I now pay directly from those spaces rather than having to move the money over. So rather than seeing what I've spent where in the budgeting app, I do it directly in the banking app that I use, because that's what we use for all of our spending. That is something else that you could consider if you do use Monzo or you use Starling, or even some of the high street banks now. They are offering categories and categorising your spending, just so that you can get some kind of insight into where your money's going each month. That will help you no matter what you do, just to kind of understand how to manage your budget, where you can cut back and where you can start saving.
Yeah, so the freeway use spreadsheets like the one that we're going to put a link to, so there's always that option. But as Lauren has mentioned, if you go committed with a particular bank, you can do all of this stuff with them, because obviously in the past it wasn't possible. So if you're somebody who has lots of different bank accounts, lots of different credit cards and things, then obviously an app like we've talked about, the budgeting apps, are very useful, and you can use them to try and get an overview of your finances very quickly and stay in control. But if you have much more streamlined personal finances, so you might just bank with one bank, for example, like Starling, then I think you can do a lot of this stuff in there and get the categorization. As you say, you can use the spaces. You can use one, for example, if you go on holiday, you could have a holiday spaces and spend directly from that when you're abroad. And obviously, this isn't a promo for Starling, but they are now paying a fairly decent interest rate on their current account. It was abysmal before, but they've just upped it. We'll put a link in the notes to the rate, actually.
And also, while we're talking about that, we can give Monzo a mention as well. Because of the cost of living crisis, they've actually made some of their premium budgeting features free, which means that if you don't pay for one of its subscription accounts, you can still take advantage of some of the budgeting features that previously was only for those that paid a fee. So that is something worth considering as well.
So that was a roundup of the budgeting app space and the alternatives to Money Dashboard. It was my view. I would love to hear what people think. People who are listening to the podcast or watching the YouTube video, do give your views, because it will help lots of people. Because don't forget, people run their finances very differently. They even use the individual apps very differently as well. So they may find, if you're a certain type of user, one of the other apps may have been a better choice. So do share that in the comments below, because it's great to share that knowledge.
Okay, so if you found that piece useful, obviously it was big news in the budgeting world, big news for us. Everyone in the office seems to use a different budgeting app and a different way of budgeting. So if you found that useful, do get in touch. Or if you found other things, like Damien said, that works for you specifically with MoneyHub, if there's ways that you've worked around the system, then please do get in touch in the usual way. Damien at moneytothemasses.com is the best way. So Damien, moving on then, we're going to be talking about mortgages again.
So I wanted to talk about a new product that's come to the mortgage market this week. And once again, it is innovative. And once again, it's been brought to the market by Skipton Building Society. And I say once again, because you may recall Skipton brought the deposit-free mortgage for renters to the market a few months back. Now, I'll put a link in the notes of this episode so people who are interested, particularly first-time buyers, they can go and listen to that episode and find out more details. But this week, Skipton hit the headlines and ruffled a few feathers in the mortgage world when they offered a 3.35% headline rate on a 2-year fix. Now, I'll give you the details in a second, but if you think that the average 2-year fixed rate is just above 6% at the moment. They have been coming down. That shows you how good that rate is. Now, of course, loan to value is important. So the amount of outstanding mortgage versus the value of your property, that would dictate the rates that you get in the market. But to give you the numbers, if you've got a 60% loan to value, you can get a 3.35% rate with Skipton, which is 2% below the best buys you can get at the moment on a 60% loan to value for a 2-year fix. Then on a 75% loan to value, the rate is 3.39%. That goes up to 3.49% for an 85% loan to value. And for a 90% loan to value, you got 3.59%. So there'll be a lot of people listening to this thinking, that's incredible. How do I get hold of one of these products? Now, there are some big caveats. So the first one is you have to be a Skipton mortgage customer already. So this is a product transfer. So you're moving from one of their products to the other. But the reason I mention it on the podcast, because there's something very interesting and significant about the product, and it's the fee. So in order for a Skipton customer to use this product or take advantage of it, they will have to pay a 5% completion fee. So you can think of that as a lender's fee, 5% of the loan. So if you've got a £200,000 mortgage and you're looking to do this product transfer, then that's £10,000. You can, of course, pay it up front if you want to, or you can add it to the mortgage. So that increases the size of your mortgage. And the reason I'm bringing it to the podcast is because this could be a direction of travel that we head into, where lenders try and compete, give good, attractive headline rates, but there are these very hefty fees. I mean, the example I gave there, you're paying £10,000. That's huge. What's a typical fee? Well, it can be something between £500 and £1,000. Typically, if you look at the Best Buy tables, I'll put a link in the notes to our comparison table so you can go and search on there and look at some of the fees. So it is a sizable fee. So in this podcast, I really want to focus on taking into account that fee, because I think historically lots of people don't even really look at the fee. They just think, yeah, just chuck it on top of the mortgage amount. It's a relatively small amount versus perhaps the amount you borrow. So people don't look at it. Now people need to be more aware, and therefore they need to look at what the overall costs are and not just the impact on the monthly amount that you pay. So I'm going to run through an example using this new product just to illustrate to people what they need to be mindful of. So let's say you've got a £200,000 mortgage over 25 years and it's a repayment mortgage, and it doesn't matter what interest rate you're on. For this illustration, you're going to go and take advantage as an existing Skipton customer. You're going to go and have a product transfer. So there shouldn't be any affordability checks because it's a product transfer. And you move on to this product and you've got a 60% loan to value. Your monthly repayments are going to be £1,034.50. Now, by comparison, had you gone and used a product transfer to one of the existing products for a 2-year fix, again, because this product is only a 2-year fix, the existing Skipton products out there, you would have got a rate of 5.66%, which when you moved across, your monthly payments would be £1,247 a month, which is £213 more than the new product. So you can see what the attraction is. And the reason that Skipton have made this product is for the people out there who are worried about remortgaging and worried about how high their mortgage payments are going to be, and they're worried about struggling to afford those repayments. So this is the product that they brought out for those people. But as you'll see, this won't be for everybody. Now you can see there's a £200 saving there, which obviously is attractive. But I want you to be mindful of what's happening in the background in terms of your outstanding balance. Now, if you've taken out the new products, you've done a product transfer, your mortgage on the example I said has gone from £200,000 to £210,000 because you've added that 5% fee. After 2 years, when that fixed deal comes to an end, your outstanding mortgage will be £198,889. So basically £199,000. And that's because you added that fee. You took your mortgage up to £210,000. Now, if you think about it, you really aren't any further forward than you are today before you take the product out, because obviously before you did a product transfer you had an outstanding mortgage of £200,000. You've really just kicked the can down the road because you've been paying mortgage payments, but you really haven't chipped away that much. Only £1,000 has really come off of the total of your mortgage compared to where you are at the start with the £200,000. Had you instead gone on to Skipton's other product and you're paying that higher rate, 5.66%, a £1,247 a month payment, then after 2 years your mortgage balance would be £192,293. So significantly lower than if you'd use the new product. And what that means when you come to remortgage or look for another product transfer, perhaps in 2 years' time, then the amount that you're going to have to look for is going to be higher if you use the new product with the 5% fee. Now, we don't know what products are going to be available out there. We could all be paying north of 5%. The sort of innovative products like this one might not exist. So what will happen is you're really kicking the can down the road. And yes, if you take an assumption that you're paying 5% in 2 years' time, so a pretty hefty rate, then because of that differential in the outstanding balance, you'll probably end up paying £40 to £50 a month more if you use the new innovative product because you've got a larger outstanding balance. So that's something to bear in mind. You might think in the short term, the £200 a month saving is worth that to give you 2 years breathing space, but then you are going to be paying more in the long run. You're going to be kicking that can down the road. So that's something to bear in mind. Also, don't forget, if you're going to be adding 5% to your mortgage balance, you could go over a threshold for the loan to value. So you could end up being eligible for a worse rate than you otherwise would be because you may have crossed over into a different threshold. Because don't forget, it's done in brackets. So you could have moved from the 85% bracket to the 90% bracket, for example. So do bear that in mind. Now, of course, yes, you could pay the fee up front, but then I would point out to that, if you paid in that example I had a £10,000 fee up front, you could have just put that money in a savings account, earned some decent interest, and actually subsidise your mortgage by the amount of £200 a month from that savings account over 2 years. So £200 a month taken out of that every 2 years, that means you've only got to put just under £5,000 into a savings account. So obviously this product won't be for everybody. Now, one thing I would say is that, of course, we've assumed you're doing product transfers. You may be in the fortunate position that your finances have been resilient. You still can qualify for remortgage elsewhere because you can pass affordability checks. Then if you shopped around, then you can get 5.36% with somebody like First Direct with a 60% loan to value, and the fee's only £490. Now, if you did that, then your monthly payments would have been just over £1,200 a month. So that would be around about £180 more, which is a little bit better than if you just done the product transfer onto the non-innovative Skipton Building Society product. So the point is, it's still important to shop around, and you need to be mindful of the impact that these fees have over the long term, because you are effectively paying interest on any fee that you add to your mortgage. So of course, Skipton aren't trying to claim this product is going to be for everybody. It's aimed at a certain type of customer, but if this is going to be reflective of the mortgage market, the message is now you need to be particularly mindful of the impact of fees on your mortgage repayments and your options going forward. So what could it ultimately mean for your choices and the amount you're going to be paying in the future when you come off of that deal? Now, of course, go and seek advice, because a good mortgage advisor can tell you what's best for you, give you all your options. We can put a link in the notes of the podcast to a service where you can go and find a mortgage advisor who can help you and be objective and look at the whole of the market. So of course there are other options too. So you could decide, if you were able to remortgage because you could pass the affordability test, you could decide to do other things, like you could decide to extend the term of your mortgage, but that will end up meaning that you will be paying much more over the term of your mortgage. If you look at the numbers, they can be quite frightening. I know people just try to kick the can down the road, but at some point you are going to have to pay your mortgage back. So it's worth bearing that in mind. And the FCA even came out this week and reported that they are concerned about the number of people with 35-year mortgages now. So if you look at the numbers, again, I'll put a link to our news story on it in the notes of this podcast. If you go back to the first quarter of 2021, only 4% of homeowners had a 35-year mortgage. Then by the second quarter of 2023, that's jumped to 12%. Now, they are concerned about it because it increases the overall cost of your mortgage, and you may end up having to work for longer to end up repaying your mortgage, and it can limit your options going forward, particularly if it starts to take you into retirement. Now, I just want to give people, again, headline numbers. If you had a £200,000 mortgage over 25 years, assume a 5% interest rate throughout the whole thing. That's not obviously realistic, but it's just to keep the numbers simple. Then the monthly mortgage payment would be £1,169. If instead you change that to a 35-year term, that would knock it down to just over £1,000. But the overall cost of the mortgage, that £200,000, would have cost you £350,754 if you paid it back over 25 years. Over 35 years, that number jumps to a somewhat incredible £423,938, and it's because you're paying interest for longer. Of course, that is assuming that constant interest rate, which isn't realistic, and you can obviously refinance and change things going forward. But make sure you shop around. There are other options for you, things like offset mortgages, switching part to interest only mortgages, something we talked about in the podcast. Again, I'll put a link to past episodes that cover that topic. And of course, there is the option of overpaying your mortgage. So for some people, they won't have the options of overpaying, but there are going to be people out there who have listened to this part of the podcast and maybe are thinking, I like the attractiveness of that offer. They may have been a Skipton customer, but let's say other people follow suit, then they may have the option to be able to do other things. And so don't just look at that headline rate and make a decision that you might ultimately not realize could end up costing you more in the long run.
Okay, moving on to the final piece of the podcast then, and this was inspired by a listener who got in touch via Instagram.
Okay, so the final piece is about savings, and in particular the taxation of children's savings. And it was inspired by an Instagram message that said, "Hi Damien, love your Instagram and Spotify podcast. I have a question for you if you don't mind. I have opened a Halifax Kids Saver account at 5.5% for the first year. My question is, am I better off putting that money into my ISA account so it's shielded from tax? I understand that I only get £500 interest free a year in savings as I am a higher rate taxpayer. Thank you." Now, this just really gives a nice introduction into explaining some bits around how children's savings are taxed, because there is a tax trap I don't think many people actually realise, and I think a lot of people are starting to potentially fall foul of, and it's because interest rates have become much more generous on all types of savings accounts, including children's savings accounts. Now, the first thing I would say on Halifax is that there are other children's accounts out there. Just because you've gone over that 1 year, Coventry Building Society at the moment offer 5.25%, and Saffron Building Society have a children's regular saver that actually gives 5.8%. So you have options to move it into another children's savings account because the rates are generous across the board. It used to be the Halifax one was the standout, but after a year when the rate drops back down, you can of course move it if you so wish. So that is an option. Now you are wondering about shielding it from tax, and you are correct. You could take the money and put it in your own ISA, but then that money is in your ISA. It's not technically earmarked for your children, but you may be okay with that. But the most obvious thing, if you really wanted to shield it from taxation and want it earmarked for your child, then you could put the money in a junior ISA. So don't forget, you can put up to £9,000 a year into a junior ISA, and that is completely tax-free and it belongs to the child. And I know for some people that may be uncomfortable, but at age 18, they can take the money out of the junior ISA. My view is that you could, in the interim, teach them about the importance of saving and investing if you wanted, but the money is theirs. You may decide you don't want to give that over to them indefinitely because you're worried they might end up wasting the money. So one thing I do want to point out to people though, so there is obviously the ISA angle that I've just mentioned, but it does lead on to an important point about the taxation of interest on children's savings accounts. Now, a lot of people don't realise that once a child earns £100 or more in interest on their savings account on any money that's gifted, this is important, by the parents, it's then taxed as though it's the parent's money. But even more importantly, if you hit that £100 amount, then the interest, all of it, not just a bit over £100, is counted as if it belongs to the parent, and it counts towards their personal savings allowance and taxation. So it does become important, because in the current environment where you can easily get 5% on a children's savings account, you only have to have gifted £2,000 or have a total of £2,000 now, it's grown to, and you're getting 5% interest on, you will hit that £100 mark in a given tax year. So there'll be a lot of people now listening to this suddenly realising that they fall foul of this tax rule. Of course, if the interest that your child has earned and your own interest falls within your personal savings allowance, then everything's fine. So what can you do about it? Obviously, the main way, I've already said, is to use an ISA. But going forward, people need to be mindful as they're building up amounts of money for their children that they could fall foul of this tax rule. So there are things you can do to try and mitigate that. So the first thing you could try and do is actually get family and friends to put money into the savings accounts, because they could say make gifts for birthdays or whatever. That money is always taxed as the child. You need to keep careful records, because you need to know what amount of money in the account came from you as a parent versus other people. But if other people put money in the account, then that interest earned on that amount is classed as belonging to the child. And children have their own personal allowances and savings allowances, so bear that in mind. So they can earn a decent amount of interest. Obviously, it's going to have to be a huge sum of money to be able to breach their personal allowance, because that's meaning you're going to have to earn over £12,500 a year. But of course, there are some people people, even though very few, who will breach those levels. Another way around it is if you have gifts from both parents. So you can do it from a joint account, so any money you pay is assumed to be 50-50, or you could do it from individual accounts. Then what happens once the interest hits £100 on the portion that each parent has deemed to have put into the savings account, that's when the interest is taxed under their taxable income. And of course, this then leads to a bit of planning. For example, one parent may have a portion of their personal allowance left, which the other one doesn't. Then if you're putting large sums into children's savings accounts and is generating a lot of interest, then it would be better if the person with the unused personal allowance put the money in. So you can see there are ways to work around it, but it's important that people understand that there is a tax liability looming for a lot of people. And of course, don't forget there's a savings starter rate, which we'll put a link to in the podcast, which can give you an extra £5,000 in addition to your own personal allowance. So that's something to bear in mind.
Okay, so that's it. We're done for this week. If you want to get in touch with us, you can do so in the usual way. It's Damien at moneytothemasses.com, or of course, Andy at moneytothemasses.com. Please do review the podcast if you can in the usual way via the app of your choice. 5 stars always helps, and it helps us to raise up the charts. You know that bit by now. And of course, we've had lots of people join the Money to the Masses community group over on Facebook. Please do add yourself in there if you haven't already. It's facebook.com/groups/Money to the Masses.
And of course, don't forget to follow us on our social channels. So, Andy, that is it for this week. Until next time.
Until next time.